Now, the part of the show where I talk about three things that I believe individual investors should be looking at, focusing on before you make your investment decisions. And our first point here, jobs, inflation stats coming out for 2025. Our first look at jobs numbers. Well, I guess it would be a December jobs number, right? But it is our first jobs data in January, not for the month of January, obviously, but for the month of December. We're also going to get inflation statistics out of the US next week. We already had some jobs numbers coming out in the last couple of days. JOLTS, job openings, were released recently, and they were actually quite strong. So we're going to get a lot of economic data. Retail sales, another one, is going to be coming out in the US. We're also going to get Canadian jobs coming out on Friday with US jobs data. Number two, interest rates and the dollar are moving higher. This is not good for the stock market, not good for markets in general. Whenever interest rates are higher, we saw what happened back in 2022. Market doesn't like higher interest rates. We're seeing interest rates moving higher. And with that, and with the weakness on the Canadian side, with respect to everything that's going on here, we're seeing a stronger dollar versus the Canadian dollar. We'll talk about that as well. And lastly, our third point, corporate earnings season is approaching. I have a few stocks that I want to highlight that I think are important to look at for, I guess, a barometer as to how good or how well the U.S. economy is doing. A couple of market leaders, a couple of standouts that I want to touch on. So we will get into that as well. So let's move to the first point, which is economic data. As I said, we're going to get a lot of data coming out in the next 1 to 2 weeks. We're going to get inflation data, as you see here on our image. We're going to get first jobs data coming out in a couple of days. Interesting, tomorrow the US markets are actually closed because of the death of former President Jimmy Carter. I believe he lived to 100 years of age, which is fantastic. But in respecting the president, the former president, I believe his funeral is tomorrow. They are closing the stock exchange. So today, Wednesday, and then we won't be, or at least the markets will not be back open in the United States until Friday, and that's when we get the jobs data. So our first chart here talks about JOLTS. As I said, JOLTS, which are your job openings, and labor turnover is what it stands for, what JOLTS stands for. And as you can see here, that job openings rose to 8.1 million, but yet hirings are falling, and they fell to 5.3 million. So whenever you have more job opportunities or openings than and not really that many people to fill them, or people aren't filling them, that is a bit of a negative for the Federal Reserve or a central bank, because that can lead to inflation. So when you have lesser people chasing all these different jobs, they can demand higher wages, and therefore higher wages leads into inflation. So JOLTS numbers definitely play a factor, and something that the Federal Reserve is definitely watching. Our next chart is on monthly job creation in the US. Again, a number we're going to get on Friday along with the Canadian jobs number. We saw the strength in jobs, 227,000 jobs created in the month of November. October was a bit of an anomaly because we had those storms. If you remember, a couple of hurricanes came through and the numbers were definitely distorted, all the destruction that those storms caused. So the jobs numbers weren't accurate for October. But if you look at September and November, very strong jobs growth. And again, a point that the Federal Reserve is looking at with job growth very high. That takes care of one of their mandates, right, which is full employment. And it might lead the Federal Reserve to only cut rates maybe once or twice this year, or at all over the next 12 months. They don't see the need to be very quick on the cutting of rates, and that's because job growth has been so substantial. Next chart, retail sales. Retail sales have been really strong in the US as well. And you can see here, we'll pull up, there it is. Monthly retail sales advanced 0.7% in November, 0.5% in October. We'll see what the December numbers look like when you take some of them are counting X autos or not including automobiles. Some of them are including autos, general merchandising. You can see here that retail sales have been extremely strong in the United States. And it's something that, again, another data point for the Fed to consider. Our next chart is actually on Canadian stats, Canadian jobs growth, Canadian employment change. And as you can see, in November, 51,000 jobs were created in the month of November in Canada. Yet our unemployment rate jumped up to 6.8%. It's hard to figure out how that could happen when you're growing jobs at that pace. You figure that Canada is about a tenth the size in terms of population to the US. So 51,000 jobs created would be equivalent of over 500,000 jobs created in the US. So you can see how strong of a number November was. Let's see what December brings. And if it brings the same kind of data, what does that mean for the Bank of Canada? Will they be as quick to cut rates this year? Next chart, US price index, consumer price index, CPI. There you have it. Headline number, 2.7%, still above the target of 2% in the US. In Canada, we'll see that number shortly. We're down to 1.9%. So we're at target, whereas the US still have a ways to go. Factoring out volatile food and energy prices, you get a number of 3.3% for CPI. And that obviously is a lot higher than the Fed wants. Next chart we have, which is one we've seen many times, Bank of Canada's key interest rate versus the inflation rate. And there you have it, 1.9% inflation. 1.9%, yes, inflation, and a Bank of Canada rate of 3.25%. And we've seen this rate come down significantly. What is the neutral rate that both Bank of Canada and the Federal Reserve is looking for? Well, that remains to be seen. We think that maybe the Bank of Canada neutral rate might be somewhere around 2.5%. That would be possible. And maybe they cut another 3 times this year to get us there, or perhaps another 75 basis points, or maybe a full percentage point, get us down to 2.25% by the end of the year. So we'll have to see how that plays out. Obviously, it's playing out in our currency markets, which we'll get to in a second. But obviously, the Bank of Canada is going to do what they need to do to stimulate the economy, and that may mean continuing to cut interest rates. Our second point that I had on our list of 3 is talking about interest rates and the dollar moving higher. It's unbelievable that the U.S. Fed continues to cut rates, albeit when they cut rates, it's more on the short term, but yet all the treasuries, all the interest rates on U.S. bonds continue to move higher. And as I said earlier, not a good thing for the stock market. Here we have the U.S. 2-year. When this was taken, I believe a day or so ago, it was just under 4.3%. I believe that the 2-year actually went above that in the last 24, 48 hours and has pulled back a little bit today. Again, you can see here from the chart, it continues to rise. The 10-year treasury or 10-year bond rate, probably the most important one that we all look at. We know that mortgage rates are set off of that. Look at that one, almost 4.7%. It actually ticked above 4.7% in the last, as I said, 24, 48 hours. And so what we're seeing is interest rates in the US are moving higher. The 30-year bond rate actually touched 5%, something we haven't seen in a couple of years. And obviously with bond rates moving higher, mortgage rates are definitely moving higher in the US. And as we know, this is slowing down. This has the effect of slowing down the economy, certain segments of the economy, like interest rate sensitive parts of it, such as technology, such as real estate. So higher interest rates, not good for the economy, and obviously not good for our economy here in Canada. But we're still looking at perhaps 3 to 4 cuts this upcoming or during this year, 2025. Our next chart is on currency, and you can clearly see what the currency effects have been as we lower rates in Canada faster than the Fed does in the US. Look at the effects on currency. US dollar has surged versus a basket of other currencies. You can see here in the middle how much the Canadian dollar has fallen, almost 8%, whereas the United States or the US dollar has surged about 6.6% ahead. And we're not alone, right? You can see all these different currencies, the euro, the UK, Swiss franc, everybody has fallen by the wayside. The US dollar has continued to gain strength. I've done a few interviews in the last 48 hours on radio right across the country, actually, talking about what has happened with respect to the prime minister resigning, the effects on currency, what has affected. And yes, the resignation and at first, actually, our dollar surged, but then the proroguing of government. Now, really, there is no government, at least at this point, no parliament at this point. I think that is weighing on our currency as well. But nonetheless, the US growing at 3% and us growing at around 1%, that is probably the biggest factor in why our currency is as low as it is. Our final chart on this is one that will show you that our currency is sitting at around 69 cents. There it is. Look at that fall off since it looks like, if I had to look, September, a real large fall off. And that's when Canada really started heating up with the cuts in interest rates. And that's when our dollar really fell off that cliff. And boy, is that a cliff. Our third point, corporate earnings, something that individual investors should be looking towards. Corporate earnings season is kicking off, usually kicks off with names such as Delta Airlines and the big banks in the US. We're going to get big bank earnings shortly, but a few names I wanted individual investors to have in the back of their minds. First one, JP Morgan. Let's pull up a chart of JP Morgan, largest US bank, one of the largest banks in the world today. You can see how well JP Morgan stock has done, slightly off its all-time highs, but it's done extremely well. And I think JP Morgan is important to focus on because it's going to give us or tell us how the US economy is faring. Who else but to go to JP Morgan, the largest bank, to give us the pulse of the US economy. So let's keep an eye on JP Morgan, and they're set to report earnings at the start of earnings season. Next chart, Alphabet, another what I believe is a good indicator for how well the economy is doing. They do a lot of different things, obviously, search and ad search and generating revenues in the cloud. And their cloud business has been growing, and artificial intelligence. And they're even involved in Waymo, driverless cars. They're pretty much right across the board, their browser and everything. So I think Google or Alphabet is a pretty good indicator, a name to watch to see how their earnings are looking like. And we've seen Alphabet stock move significantly higher coming out of, I guess, towards the end of November. December was a good month for Google or Alphabet stock. December, it's kind of been a bit flat, and January starting off a little bit flat. But overall, I think it's a name you want to take a look at. Next chart is a chart from our favorite fruit, as I say, Apple stock. And being the largest company in the world today, taking back the #1 ranking as the largest by market cap, almost hit $4 trillion recently. I think the stock has to get to 264 before it becomes the first $4 trillion company. It was the first to 1 trillion, 2 trillion, 3 trillion, and there's no reason to believe it won't be the first company to 4 trillion. And it has taken back the lead in as the largest company in the world. So obviously a big company or an important company to watch. And last but definitely not least, Amazon. Amazon, what don't they do, right? Everything from pharma to food with their Whole Foods to pretty much anything. Them as well as Walmart, biggest retailers in the world today. Amazon being the biggest online retailer, but they're also AWS, which is their cloud. They're in, obviously, they have their AI business. You name it, they do it. Very important company for us to figure out the pulse of the economy and get a good indication as to how things are doing. So overall, corporate earnings season is about to kick off. I think if you look at that, if you look at economic data, as well as what the dollar and interest rates are doing, I think those are the three things that you need to consider before you make your investment decisions over the next couple of weeks.